Okay, let's unpack this. Ever wish you had like a crystal ball for your tax liability, especially if you own a house or maybe you're dreaming of buying one?
Yeah, you feel like you're wading through, well, a jungle of rules and numbers sometimes.
Ah, definitely. Well, today we're diving deep into a pretty remarkable tool.
Yeah.
An income from house property calculator. Our mission for this deep dive is basically to show you how this calculator can cut through some of that noise.
Yeah.
Give you a clear side-by-side picture of your tax situation.
Exactly. And it's not just about, punching in numbers. It's really about letting you quickly compare your potential tax under both the old and the new tax regimes.
Right.
And it does this for both the current financial year, 2024-25, and the upcoming 2025-26. It's about, well, empowering your decisions with actual data.
And finding it is pretty easy, actually. Just search for Smart Study blog. Should be the first link. Then you just navigate to the tool menu. You'll see it right away. It's got a really clean, intuitive design.
Yeah, it's quite user-friendly.
So let's walk through it. You start with basic details. Why is picking your age category below 60, 60 to 79, or 80 and above, why is that the first big step?
Well, it's vital because the old tax regime specifically has different benefits. Tax slabs and standard deductions can vary based on age.
Ah, okay. That makes sense.
So that impacts your taxable income quite a bit. Then you pick your financial year, obviously, and your preferred tax regime, new or old. And here's where it gets really interesting, I think. The guidance and information section, it updates instantly based on your choices.
Oh, neat. So it gives you context right there.
Exactly. Like for the new regime in FY 2025-26, it'll show that income up to 12 lakhs can effectively become tax-free. That's because of the Section 87A rebate.
12 lakhs, wow. But there's a patch, right?
There is. The trade-off is losing those common deductions, things like Section 80C or the home loan interest deduction for a self-occupied property. Those are available in the old regime, but then again, the tax slabs themselves are different there, so it's a balancing act.
Right. So, okay, what does this mean for your specific house then? The calculator handles the two main types, self-occupied property and let-out property.
Correct.
For a self-occupied place, the one you live in, you enter your home loan interest. What do we need to remember about those interest deductions, especially with the old versus new regime thing?
That's a great question. For self-occupied, under the old regime, there's usually a limit on that interest deduction. Generally, it's up to 2 lakhs if the loan was for buying or building the house.
Okay.
Or 30,000 if it was just for repairs. And that can make a real dent in your taxable income.
But not in the new regime.
Correct. Importantly, the new regime. It just doesn't have that specific deduction for self-occupied property interest at all.
Got it. Okay. And what if you rent your property out? The let out section looks like it needs more info. What's it asking for with municipal value, fair rent, standard rent?
Right. For a let out property, those inputs are key to figuring out your gross annual value, basically the potential rent. Municipal value is the council's valuation. Fair rent is, well, what similar places nearby rent for. And standard rent, that's sometimes set by rent control laws, kind of an upper limit. You also put in your actual monthly rent and any municipal taxes you paid.
Okay.
And here's a key point for landlords. For let-out property, there's actually no upper limit on deducting the home loan interest. That can be a significant benefit.
Interesting. Okay, moving beyond just the house details. The tool looks at your whole financial picture under incomes and deductions. You put in your total annual income, excluding house property. Simple enough.
Yes.
And then below that, those crucial tax-saving bits.
Yes. Deductions under Section 80C. This is, a really major factor if you're considering the old tax regime.
Right, the PPF, ELSS stuff.
Exactly. Public Provident Fund, equity-linked savings schemes, life insurance premiums, even the principal part of your home loan repayment. It lets you deduct up to $1,50,000. Big chunk. It is. But, and this is key, that whole 80C deduction category, it basically disappears if you choose a new tax regime. So that's a major decision point right there.
Definitely a big difference. Okay, so you've put everything in, you hit calculate tax liability. What does it spit out?
The beauty of it is the detailed breakdown. First, you'll see your house property income or loss. It shows how it calculated that gross annual value, net annual value, the 30% standard deduction for let-out properties, and your interest deductions. And it clarifies something important. If you have a loss from house property, you can only offset up to 2 lakhs of that loss against your other income in a financial year.
Good to know.
Exactly. Then that house property figure gets combined with your other income, shows your total income, both gross total income, and then net taxable income after any ADC deduction if you use the old regime. And finally, the bottom line, your tax liability. This shows the actual tax on income. Then any rebate under Section 87A, which, like we said, can be quite high in the new regime, potentially making up to 7 lakhs or even 12 lakhs effectively tax-free, depending on the year.
Okay.
And your tax after rebate, any surcharge if your income's high enough, and the health and education cess, and boom, there it is, your total tax due.
Wow. Okay. That's pretty comprehensive. And you mentioned the guidance and information section again?
Yes.
Yeah.
Always check that section below the results. It gives valuable context specific to the options you picked. It really helps make sense of the numbers.
Yeah, sounds like it really shifts tax planning from just, well, guessing to actual strategy. This tool seems fantastic for getting quick estimates and making smarter financial decisions.
It really is. And it sort of brings up an important question for you, the listener. Considering how much the rules vary between regimes, property types, and even financial years, how might regularly, using a tool like this, empower you? How could it help you proactively adapt your financial strategy as things change, rather than just, reacting when the tax bill arrives at the end of the year? Something to think about.